Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. I don't know why I always say that. Am I welcoming myself back? Am I welcoming the listeners back? Yeah, I don't know. Hey, if you hear anything you'd like to get more information on this show, feel free to go to my website, it's bullingtoncapital.com. You can, there's a contact us page there. When you fill in the contact us page, it's very helpful if you fill in what kind of questions you have. It could be just general or anything, but oftentimes people will fill out the form, but they forget to ask the question. So anyway, I'll still email you back. It's just that I'll email you and say, okay, what kind of question did you have that I could help you with? And just adds another step, but no big deal. And I'll tell you what is a big deal. The developments going on around the world, it's kind of wild. Interest rates have jumped up dramatically. If you've got, most people have a super high percentage of their portfolios in fixed income bonds, and rightly so, especially depending on your age. But that has changed so quickly, much faster than I think anybody had anticipated. And there's a new product out. It's a software product that's made available by one of my custodians that allows us to go in and see what kind of bonds there are that we might be able to buy. And you can kind of lay out all the parameters that you want. It's interesting. It is fascinating. I have never seen a platform as sophisticated as this one. And I think it's really going to help. I think it's really going to help when you're talking about buying bonds, government bonds, CDs. CDs, they've changed the market for CDs forever. When a CD gets out there, when a bank issues a CD, okay, now they're taking that, and they've been doing this for quite a while. It's just that it's picked up in popularity here over the past couple of years, really hugely over the last 12 months. So what a bank will do is they will take a CD that they have, that they've guaranteed, and they will actually sell that CD to another institution, kind of like Fidelity. So Fidelity will buy those CDs from the banks and then resell them to the public. Now the banks, with interest rates going up, oftentimes are willing to take those CDs, and they're willing to take less than they paid for them. That's called a discount. They're willing to discount the CDs to sell it to Fidelity, who will then in turn pass a portion of that discount on to you. So you might not even have to pay $1,000 for a $1,000 CD. That gets added into your total return. And it gives it gives the interest rate a nice boost. Okay, so that's pretty good. And when we come back from the first 15-minute break, I'll actually have some numbers for you that, what are the current rates. Now, they're not like the 1980s. When I got into the business, CDs were paying something like 10%. And that wasn't the height of the peak of CD interest rates they peaked way back in the early 80s, back when I was just getting out of high school. And that's when the interest rates in this country peaked. Those were the highest that were ever recorded. And they were still right around 10% when I was getting into this industry. They're nowhere near that. I'm not sure how long it would take to get to that level. But if interest rates are going that way, you really need to do some serious planning, because you can get hammered. Over the past 4 to 5 years, the average bond funds got negative returns. I mean, that's just because the principal kept going down despite the fact that they were paying dividends, which is lovely. That means you had to pay tax on the interest that you're receiving despite the fact that your principal was going down. Now, there is a solution to that. You can actually sell those funds. And if you're buying bond funds, I buy a lot of bond funds. You just want to make sure that the average maturity on the bond fund is not greater than 2.5 years. That we've been doing that for a while now. And quite frankly, it's stemmed some of the bleeding. So it was a good move. And if you don't have enough money to qualify to buy individual bonds or CDs, which is not that common anymore, you can get started with a fairly small dollar amount now. But in the old days, I mean, you needed $50,000 to $100,000, and that's one of the reasons you haven't heard me talk about that, because that's just for one CD or one bond, and that typically doesn't make up all of your money. So, in other words, you're probably going to have more like $1 million to have that make sense. Well, with the technology that's available today, you don't have to have the really high asset amounts to be able to participate in those markets. That's one of the things I really like about this. This has been made available to people like me, to make available to the general public in a way that we haven't been able to do it before. It's a little bit more manual, but I think it's worth it. And I'll come back to this in the second part of today's show. So if you want to keep tuning in there, if you can't listen to the whole thing, you can go to thefish.com and it's there as a podcast. It's on my website as a podcast. It's on iHeart as a podcast. So you can pick this stuff up if you have to do something else in the next 20 or 30 minutes. And I'll talk a little bit about, just the economy in general. It's unbelievable. If we didn't have the supply chain backups, people would be, the economy would be going nuts, even with what's going on in Europe and with Russia. Actually, that's accelerating a lot of the spending. And a lot of this, people don't realize when we send that money over, or those to countries like Ukraine, that money was paid for by U.S. citizens. I mean, the money that we're sending. And we're not going to get that back. That's actually got a bright spot to it. The fact is, if we printed that money and kept it here, inflation would be higher than it is. If you spent that same amount of money in the United States, but when you take it out of the United States, it's no longer a part of our economy. We spent the money, but it's over there. Okay, so if you leave it here and people are spending it and paying taxes on it, it just creates a higher inflation rate in the United States than it potentially could by sending the money overseas. So I know a lot of PhD economists are just rolling their eyes right now and don't agree with that. Well, too bad. Get your own radio show. I'm just kidding. And in the grand scheme of things, economics, it's known as the dismal science, because there's the way it's supposed to work, and then there's the way it actually works. And it's kind of like betting on sports. I mean, you think you know who the better teams are, but it doesn't always work out like you think it's going to. And that happens a lot in economics. I mean, it's mind-boggling. So makes it pretty difficult, because I know, I see the speeches. I've seen them for 40 years now. I can't believe I'm this old. Almost 40 years. But kind of funny. And right now, what you're seeing is that, there's an awful lot of demand. When you spend money, economies grow. There's an inflation rate that comes with that, by the way. Nobody knows exactly what it's going to be. They measure the current inflation rate, and they try to make adjustments to whatever they see happening currently. That's what the Fed's job is. They're going to try to control the economy through the money supply and through speaking with government on how they're going to be spending money. They really don't have a whole lot of influence on them. But that's okay, because Congress doesn't have a whole lot of influence on the Fed either, and they shouldn't. It should be separate. It works really well. It's why the United States, with 5%, I think we're 5% of the world population, somewhere around there. Yeah, right around 5% of the world population, 20% of the output. Think about that for a second. That should not be that way. Why is it that way? Well, I'm going to tell you, it's my personal opinion, it's because our banking system, it allows us to move much faster than other worldwide economies. So it's kind of neat. We've got this in our back pocket. It's easier in the United States than most other countries around the world to set up and start your own business. That's why so many people come here. Not that it's easy, it's easier. It's actually, I can tell you for a fact, it's not easy, but it's easier than it is in other countries around the world. So anyway, we're a little bit more flexible. Financing's there. I think I hear the beginning of the music. Or no, I didn't. That was somebody making noise. But anyway, when we come back, we'll talk a little bit more about where the economy might be headed, what kinds of areas you might want to be concentrating in as far as investments go. I'll come back to talk about how the bond laddering or your bonds, the fixed income portion of your portfolio, the best places for it now, included fixed indexed annuities, the fixed part being the part that you really want to pay attention to, and any other things that actually have a tendency to pop up in my mind. Yeah, that's what we're going to talk about. Now that I hear the music, we got to take a quick commercial break. You listen to Bill Bullington right here on 1420. Stay tuned, because I'll be right back.
Traded all my blindness for sight. Traded all my pain for the gain. Got a key to the gate and a seat at your table, yeah. I look up and I can see it got me where I wanna be. Every single part of me becoming something heavenly. You make me brand new. It's like I'm rising up from the water, living in the light you've called me into. Every day's a new beginning. My heart's like a church choir singing. Hallelujah, hallelujah. Things are getting real. Jesus, take the wheel. Only way I'm getting to the other side. Days are getting dark. Life's a little hard. Blinded, but I'm trying not to lose sight. I don't got this. I know you got this. Yeah, yeah, yeah. And I'll believe it before I see it. Yeah, yeah, yeah. I know you're gonna see me through it. If anybody can, you can do it. God, I know in the trial and the pain.
And we're back. Hey, this is Bill Bullington here every Saturday morning, 11 to noon. If you'd like to reach out and talk to me about anything you hear on this program, feel free to go to my website, bullingtoncapital.com, or you can call us 330-664-0700, and I will try to get back to you as quick as humanly possible. And, we were talking about bonds, and there's the reason I'm spending so much time on this is because interest rates are starting to go up, and they're getting to be a little bit more attractive, actually a lot more attractive than they have been over the past couple of years. So it's a big deal because 40% of assets are typically, investable assets in financial markets are typically parked in bonds. That's huge. Actually, the bond market's 3 to 4 times larger than the stock market is. And there's a good reason for that. So anyway, one of the other alternatives, and we talk about this fairly frequently on the show, because at some point in time, some people want to really try to reduce the amount of risk they're taking. So bonds give you the opportunity to do that. One of the other things that we talked about is, I have been talking about fixed index annuities. I look at the guaranteed portion. That's what's most important to me, is when I'm looking at that, the guaranteed portion. I don't think the underlying investments are going to compete with the guarantees. That's why I don't really spend a lot of time. Time is money. That's why I don't spend a lot of time talking about the underlying investment vehicles, and they've got some nice ones. The problem is I just can't imagine them outperforming the fixed guaranteed portion because it's pretty high. I think an average 70-year-old would be getting somewhere around 6 to 6.25% guaranteed for their lifetime, no matter what happens to the stock market. Now that's pretty high. These bonds we're talking about, they're paying half or less than that, which is still a lot higher than it was 18 months ago. But this is like kind of an intermediate step. It's a step in between fixed income and pure stock funds. Okay, so the fixed index would be in the middle there. The safest that you can do, now you can make your fixed income portfolio really risky by buying junk bonds. That's not a good idea in my opinion. You're not getting paid enough money to take on that kind of risk. So I would stick to just the super high quality bonds that are out there for your super safe money. And then you might go into, I need a little bit more income than that. Okay, we can bring in a fixed indexed annuity. That's going to have a higher guaranteed income, but that is fixed, by the way. It's going to stay fixed. So you still need the growth. That's what the stocks are for. We're going to hopefully over long time periods, stock returns tend to come in we're hoping that they come in over their super long-term averages. If you go back to the 1970s, early 70s, okay, when S&P 500, which wasn't even around back then, it wasn't a fund that you could invest in back then, but they just were calculating the index. It was down over 50% between 72 and 74. And the NASDAQ was down over 70%. Sound familiar? And that stuff kind of happens every once in a while. That's why we don't put all of our money in stocks, our stock funds, because they're extremely volatile. And if we have another period like that where they go down and it takes them 10 years or longer to recover, that's really going to have a major impact on your ability to maintain your lifestyle in retirement. You got to watch that. That's why the fixed income balance, how much you have in fixed income versus how much you have in stock funds, really you need to pay attention to that, particularly in the first few years of your retirement, particularly then, because those first few years are going to have a huge impact on the rest of your retirement. If you happen to retire in 2000, March of 2000, when the market peaked, right before it dropped 50% and took 3 years to finish that long, dismal decline, was down over 50% in March of 2003. That happened to be the bottom. It took it until November of 2007, took the S&P anyway, until November of 2007 to recover, when it promptly went down 57%. And had you invested, if you had retired in March of 2000, by the way, this is why I'm not retiring, because with my luck, that's exactly what's going to happen again. And so you learn, if you stay in this business long enough, you're going to learn that you can't rely on luck. You're going to have to develop a plan so that even if the economic conditions aren't the greatest, or happen to be like the 2000 through 2003, or 2000 through 2010. I get so excited I can't even speak. If you have another period of 2000 through 2010, where you're 10 years later and your assets have been depleted by 50% twice while you were taking money out of it, there's a really good chance you could run out of money in retirement. That's exactly what you want to do, right? By the time that I get there, I won't even be able to get a job as a greeter at Sam's or at Walmart, because they're going to be robots standing there. I hope not, but yeah, that's funny. I just lost my whole train of thought there. Well, so anyway, going back to fixed income, you've got now the whole world has opened up to us. I used to just use super low expense ratio, short-term exchange traded funds that were investing in bonds. It was just still fine. It's just they won't make as much money They're going to fluctuate. They still fluctuate. They fluctuate a lot more than individual bonds do. Even though individual bonds make up typically about 97% of the assets of those funds. Why do they fluctuate more when they're in a fund? Well, because you've made it easier for people to buy them and sell them. And the easier it is to buy or sell, the more the stock price, or the more the underlying price is going to fluctuate. And yeah, actually, when you take a bond and put it in an exchange-traded fund or a mutual fund, you've just turned a bond into a stock if it's in an ETF. You just converted it into a stock. Now, the reason you buy fixed income typically is because it's fixed. You don't want it fluctuating that much. And unfortunately, you get into a lot of funds who will take chances. I've experienced this a million times. Look, this is going to be our yield. If the yield is, say, 1 or 2% higher than the yield on a 10-year treasury, bond, and I forgot where that even is right now. Here, I can look it up really quickly. So a 10-year U.S. Treasury right now is right around 3%. That's for a 10-year Treasury. So if you've got a bond fund that's paying more than 4%, okay, there's no other way to do that than to take a significant amount of risk. So I'm looking at AAA corporate bonds for 10 years. They're only 3.8. And if that AAA rating goes away, that bond price is going to drop like a rock, and you're going to have to wait until it matures and hope that the company stays in business long enough to pay that bond off. So not really worth that kind of risk. By the way, the 2-year, they're all about 250, 220 to 1 years are at 220 now for a lot of those, the U.S. Treasuries. 2.19. That is a lot higher than it's been in an incredibly long time period. And so, again, one of the reasons I'm spending so much time talking about this is because so many people are out there looking. It's easy to get talked into things that have much higher interest rates. But if you don't understand the product, it's not a good thing. And it might be a good thing. I mean, that was my biggest concern with the fixed index annuities when I first started looking at them. Okay, you're in this. These are long-term investments. You pull out of them completely before the penalty period's over, and you could pay a fairly significant amount of money there. It's not the end of the world, but it's not as liquid as short-term bonds are. So the rate's got to be good enough to make sense. And I think if you look at those things, yeah, it absolutely makes sense. For some people, it makes a lot of sense. If you have enough money, you would be getting more than you'll ever spend. That's very rare, by the way, that happens. And you got some other guarantees there that you don't have through other types of products. So treasuries, they're very, very similar to CDs. And now that CDs trade on a secondary market, meaning you can buy and sell CDs from big financial institutions, you can shop around. They've basically converted a CD into a bond. Now it's like a real bond. And I think that's pretty fascinating. It's kind of cool, actually. And then you've got agencies. Those would be like Ginnie Mae, Fannie Mae. They pay a little bit more sometimes. Actually, their tenure from the agencies are pretty high. But if you remember, back in the financial crisis, those agencies aren't the same thing as a guarantee by the U.S. government. So there's a little bit of risk there. People took a little haircut there in the bonds that they were buying from those agencies. And then you have corporate AAA. Those are supposedly high grade. In my mind, the premium that you're going to pick up for buying a corporate bond over a government bond is just not high enough. I just don't want to take that kind of risk. See, the risk when you buy a bond from the U.S. government, U.S. Treasury, is that the price is going to change. Okay, but if you wait until maturity, you get your money back. It just matures. They give your principal back. That's a pretty good deal. If you're buying 30-year government bonds and interest rates go up, that price on that 30-year government bond is going to drop like a rock. Okay, so the price is not guaranteed the entire time like a CD is. A CD is not going to pay as much as a 30-year government bond. Well, actually, it might. Yeah, it does today. that No, actually, they don't have. They don't have 30-year CDs. They're not listed anyway. But so forget all that. Lovely that was that way. I've got about 60 seconds left before I have to take a real quick commercial break. So if you would like to get in touch to talk about how to design your own fixed income portfolios and your stock portfolios, when I come back, we'll talk about stocks more in detail. Just feel free to go to my website. You can reach out to me there. It's bullingtoncapital.com, or you can call me 330-664-0700. I'm typically not as wired as I am when I'm doing the radio program, because when I'm doing the radio program, it's early in the morning. I haven't eaten anything, and I've had a big Starbucks. Those guys are magicians, as far as I'm concerned. But anyway, hear the music. That means I got to take a real quick commercial break. You're listening to Bill Bullington right here on 1420. Stay tuned. I'll be right back.
Dark and all alone, growing comfortable. Are you too scared to move and walk out of this tomb? Buried underneath the lies that you believed, safe and sound, stuck in the ground, too lost to be found. You're just asleep, and it's time to leave. Come on and rise up, take a breath, you're alive now. Can't you hear the voice of Jesus calling us out from the grave like Lazarus? You're brand new, the power of death couldn't hold you. Can't you hear the voice of Jesus calling us out from the grave like Lazarus?
And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. You can reach me at my website, bullingtoncapital.com, or you can call us, 330-664-0700. And, I was thinking back to when I was first doing this show the other day, and it shocked somebody that I was talking to. He said, how long have you been doing the show? And I go, well, I can remember almost exactly, because it was 1996, and it was in the summer. I can't remember the month. But I have the original tape. Think about that for a second. It's a tape. And we were talking about Qualcomm. Yeah. So the guy that runs the show here at the radio station said he was only a sophomore in high school. That's good. When I was a sophomore in high school, gold was $800 an ounce. I remember that. You know why I remember that? Because it was the highest it had ever been. And we had tons of inflation, and they started this little government program. You might have heard of it. It's called Medicare. That was started in the 1960s, and they had this great idea. We're just going to print the money and to pay for it. We'll just print it up. They weren't as sophisticated as they are today as banks. So you had, and then there were other things going on in the economy worldwide. People were trying to get off the gold standards, and things were going haywire. The inflation was in the mid-teens for a while. I mean, think about that. At 15%, the cost or the value of the investment actually doubles in 5 years. 5 years at a 15%. And we had 15% inflation. And by the way, I'm pretty sure it was higher than that. Those were the government statistics that they were publishing. And I'm not sure I would trust the government that much to tell me exactly how much prices are going up by, because they have to increase the Social Security payments they're making by that amount. So, and by the way, it also affects the amount of interest that they have to pay on the new notes and bonds that they're issuing. The interest rate on that goes up too. So the interest expense is a huge cost of the federal budget. And I don't know. I guess the cynical side of me just goes, yeah, If I owed $36 trillion and got to set my own interest rate and it was based on the inflation rate, what am I going to report? No, actually, I would report it like it is. That's probably why I'll never I'll never be president. I just kidding. But anyway, so we've got stocks. Yeah, we're going to start to go over some individual stocks. There aren't a lot actually coming up on scans. Surprise, surprise. Market being down 11.5%. That's actually correction mode. When the market's down over 10% from its most recent high, which was just in January, that's considered a correction. That's not a bear market. It's a correction. It's only 10%. Bear market's typically defined as a market that is down 20%. So if the S&P were to drop another 10% from here, we would be considered to be in a bear market. And when you have these types of conditions, when markets have been dropping, the number of stocks that come up that look really good, that you might have a chance to make some decent money with relatively quickly, tend to shrivel up. There's just not as many of them. And I think I've got a whole total here. I'm going to run this again. Yeah, wow. They're only 13. Only 13 stocks. And one of them is really funny, is what used to be Philip Morris, and their symbol is MO, M-O. I don't think this is a fast grower, a big grower, but Altria Group, they is the new name. You know, they have changed a lot over the past 30 or 40 years. Anyway, you want to look at that one up, you can look it up. I'm not a big fan of that one. It just jogged my memory, because back when I first started in the industry, was like the late 1980s, that company had such a great long-term track record that everybody was recommending it. And so when it flashes up on a scan, I'm like, oh, I remember that. Yeah. And that's one of the benefits of being old is that you go back, you look at this stuff, you go, oh, yeah, I remember that. And I remember Campbell Soup. That's the number 2 stock that's showing up on the scans today. Another stock that I don't think is probably going to double or triple anytime real soon. Although it's at $48, it was at 70 back in 2016. It was also close. It was over 60 in the late 90s. Holy cow! Late 90s, that stock was over $60. Goes all the way down to $20 by 2003. Then peaks again in 2016 at just barely above where it was in 1997. That's almost 20 years. And when people say, oh, I'm a long-term investor, this is what I want to show them. Okay, this is what a long-term investor has to put up with. You get a stock that drops 2/3 of its value, finally recovers after nearly 20 years, and then goes down 50% again. That's they're aggravating, to say the least. But is Campbell Soup a good company? Yes, it is. Is it undervalued right now? I think it is. Yeah, I think it should be actually selling closer to $70. Does that mean it's going to go there tomorrow? Heck no. Stocks never listen to me. But so do I think it would be a good part of a portfolio? Yes. And it's actually a part of a lot of the exchange-traded funds that we hold. And if you tune into this show next week, I'm going to go through each one of the funds that we hold over the next few weeks, not in one day, just one week. And I'm going to read off the top holdings, how they were selected. That makes a big difference. It's kind of frustrating after all the years where people look at, well, what's just gone up the most? What do you mean? Well, that's how I pick my funds, and that's how most people pick their funds. They look at what's gone up the most. Now, they'll say, no, I'm looking at 5 or 10 years. Well, let me tell you how the best 5 and 10-year performing funds get there. They put in a blazing 18 months, probably the last 18 months, and it lifts those long-term averages up. And if you looked at it year by year, you'd be like, hey, wait a minute, that doesn't look like 15% a year. Yeah, because it's not. It was 4 or 5%, maybe even negative for several years. And then it had this great big surge, and that lifted all the long-term. And if you missed most of that surge, you're toast. And that's exactly the reason that the vast majority of investors have a tendency not to do as well as they would do if they just had a diversified portfolio and just held on to it. Because the funds within the portfolio are making adjustments along the way. They'll buy and sell Campbell's soup along the way. In fact, a big part of the fluctuation in that stock is caused by the index funds that hold it. So they're making adjustments constantly, and that's normally why mutual funds will have or exchange traded funds will have a tendency to have better track records in the long run than somebody trying to do it on their own. You'd have to devote 24/7 to this, well, at least 40 or 50 hours if you wanted to just to keep up with some of these funds. You know how I know that? Because I've done it. It is not easy. It's really difficult. And I really like the ideas. And one of the benefits of doing what I've done over my career is that when you build your own models and you test your own models, you have a better idea of what actually works and what may be just a flash in the pan. And it just gives you a slightly better idea of that. And it's probably going to hold you back a little bit over some time periods, but in the long run, you should come out very well. You should do very well. If you have large cap, mid cap, small cap, intermediate, international, and I think you'll be fine there. And I don't know about the emerging markets a little bit. And in fact, a lot of stocks like in the Russell 3000, some of those stocks are in emerging markets and they're very small. So you can pick those up. A lot of them are in a lot of the ETFs that are out there and available. Like actually, Russell's got a ton of ETFs that carry a lot of those companies. And you know that more than half the revenues of companies in the Russell 1000 come from foreign countries? Yeah, that's how those companies got to be that big. They're everywhere. So you get some exposure internationally to those types of stocks, but you don't have the same type of risk they call currency risk. It reduces the currency risk somewhat. So that's a pretty good deal. It's a lot easier today for people that want to spend the time to be able to go out and put together a really nice, well-diversified stock portfolio. And if you want to be, swing from the trees, and that's what the Bullington Capital or the, actually, no, I took that down. Sorry, I didn't have enough time. That's where you have to learn how to basically trade or be a long-term investor. And they both have various levels of difficulty. But instead of having me talk about a lot of that, I really want to just kind of go back and review what we talked about at first. We didn't cover a whole lot of economics. There's not a lot to cover right now. Everything's kind of out of its ordinary because you've got the pandemic that's still lingering around. You've got this thing with Russia that's a really big deal. It's choking supply chains and affecting a lot of things around the world. So that's affecting the economy right now. I don't think anything that you see in the economy you can actually rely on. It's all going to change again as soon as or when this stuff is pushed behind us. And right now, a lot of people are asking, should I do anything differently? No. Nope. See, when we set up a portfolio, we're looking at the past history where these kinds of things have happened multiple times. Okay, that's how I built the models that I use. I looked at those time periods and said, okay, what would have been the right thing to do? And the right thing to do is match up your risk tolerance. That's an individual item. Match up your risk tolerance with your portfolio. Keep them in alignment. Okay, and then just hold the course. You're going to have to make adjustments because you'll have years where stocks do incredibly well, and you'll have years where they're not doing as well. And you need to adjust that probably about once a year or once every other year. It's not nearly as much as people think it is. And the people who rebalance their portfolios more frequently than that generally don't make as much money. Now, when something comes up like this change that's happened because of some software that allows us to improve on the fixed income somewhat, then you might want to make changes because of that. That is one of those instances where you might want to take a look at it. It's not going to kill you if you don't, but it might help you a little bit. And I got a pretty good feeling it's going to help a lot of people a little bit. So if you're a client and you wonder why, hey, Bill, how come you didn't tell me about that? I'm telling you about it right now. And if I haven't called you about it yet, it's because I've got, we're working, burning the midnight oil, trying to get a hold of everybody just to let them know, this is a pretty good deal. You can get better than 2% on a short-term investment. You can actually get somewhere between 2.5% and 3% right now on some that are a little bit longer in nature. And I talked about doing ladders. That's where you get a 1 year, 2 year, 3 year, 4 year, 5 year, 6 year, 7 year. That's the best because, in my opinion, every year you got something coming up for renewal. So if interest rates move up, your whole rates are going to move up. That's great. You don't have to guess. When you have to guess or you have to forecast, you stand a really large chance of being wrong. Okay, so people tried. I think the quest for perfection has been the cause of many, many, many losses that indeed didn't need to be there. So we don't want to be perfect. We just want to be profitable. Because it's impossible to be perfect. And stressing out over trying to be perfect is not a good way to live your life. You do the very best you can. You try to get the best advice you think you can get, and you just go from there. And then if you've got a good plan, when the markets change, people, what are you going to do now? We're going to do the same thing that we planned on doing when we knew that this might happen. It's all the funds that we're using are adjusting on the inside. In fact, it would probably turn your stomach a little bit if you saw the buys and sells that are going on inside of an exchange-traded fund, especially one who uses momentum and profitability in the set of criteria that it uses to select funds. Those stocks are wild. They've also done very well. But if you knew that ahead of time and you knew what to expect when the market has a big correction, you wouldn't be upset. Or you might be upset, but at least you'd have expected it. And that's when I feel like people really get upset, is when something happens that they don't expect. Okay, that's one of the reasons that the fixed income, when you take fixed income and you're trying to guess, I'm going to buy 30 years, and when I think it's the right time, I'm going to sell. Good luck with that. That is just like trying to predict the stock market. And if anybody, there are two types of people that can predict financial markets: the lucky and the liars. Those are the two people that can. And by the way, guess which category is larger? I'm going to leave you with that one. You don't have to, but anyway. So if you've heard anything that you'd like more information on, please feel free to call me or send me an email. And don't mind talking about it. This is all I do every day. Poor Gary and Melissa have to listen to this all the time. But we all like what we do, and we'll try to help you in the best way we can. Everybody's a little bit different. That's the thing that I find fascinating about money management, or people's opinions when it comes to money. I've seen married couples who have completely opposite styles, completely opposite tolerances for risk. It's pretty interesting. I'm sure it makes for an interesting marriage, but better than being bored, I guess. But so it's fun when we can come in and talk and show, when you're in the office, we pull up illustrations. Like, this is how this normally happens. This is why this is happening. And just knowing why oftentimes puts your mind at ease. And I'm going to tell you, investing is 95% psychology. 95% psychology. It's 5% knowledge. That kills everybody that ever went and got an advanced degree in finance or economics because they know what I'm talking about. But anyway, it doesn't really go. There are a lot of great people I've met over the years, and they're actually most of my professors back when I was in college. I hear the music. That means my show is over. You've been listening to Bill Bullington here every Saturday morning from 11 to noon on 1420. Have a good week, everybody. Good luck. Good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420. The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.